Hello, in this lecture we're going to continue on with the logic of individual choice, the foundation of supply and demand, chapter 19. Remember that our objectives are to discuss the principle of diminishing marginal utility and the principle of rational choice, which we have done, explain the relationship between the marginal utility and the price when a consumer is maximizing total utility, summarize how the principle of rational choice accounts for the laws of demand and supply, and then name 3 assumptions of the theory of choice and discuss why they may not reflect reality. That's where we're going to go in this presentation. So apply the theory of choice to the real world. The assumption underlying the theory of rational decision-making place limits on the use of the theory. So those assumptions are, so remember, these are assumptions that are made in our model. So we've been discussing this model. We've been trying to put mathematical formulas so that we can create a mathematical model. And in so doing, we of course need to make assumptions. We need to take the world. We need to make assumptions about the world so that we can build a smaller model in which we can make assumptions and hypotheses and measure things and then see if those are really good and applicable to the world. Now, of course, when we make the assumptions, we have to say when do these assumptions apply, when do they not apply. We need to know when the assumption applies and when they don't so that we can alter the model. Now, this doesn't mean that the model is no good. It's not like we've now advanced past the point where everything we just talked about is no good. That's not the case. The case is the model is a general model. We need to know when it applies, when the assumptions may not hold, and therefore adjust the model in those cases where the model doesn't hold. So those assumptions, these are the assumptions that we are making in the models that we have been discussing, and those are that decision making is costless. There's no cost to the decision-making process. That's an assumption we're basically making. Clearly, that's not quite the case in real life. We'll discuss that further. Tastes are given, meaning individuals generally have a given taste already, and we'll discuss how that may not be the case in all cases, and individuals maximize utility. So we've discussed that's the principal idea, meaning utility being the idea that we're going to maximize our benefit. We're going to get the most benefit out of something, and that's going to be a given assumption that people are rational and they're going to try to get the best utility out of things. So we're going to discuss when those assumptions may not apply. And this has come largely out of behavioral economics, question all 3 assumptions. Note that when we think about economics, again, it's a social science, and we've been applying these models to the social science, making these assumptions. And in so doing, when we make something scientific, we really want to assume that everybody is really rational and everybody makes these rational choices so that we can make these assumptions that we make. Clearly, there are areas, though, that we have to see and measure and see human behavior and see where some of these assumptions do not apply. So we have decision making is costless. That's the first assumption. We're making this assumption when we do the model. And now we're going to see, is there alternatives to this assumption? When is this not the case, or when is this imperfect? And when is it going to be relevant or not? And we know that obviously in decision making, there is a cost to decision making. We're going to have to put in time to make the decision. Anytime we put in time, time is worth something. Therefore, there is a cost. Now, sometimes the time we need to put into a decision is pretty easy. It's not that difficult of a decision. It can be somewhat immaterial in our analysis. Other times it could be very significant, and we need to take it into consideration. So the cost of deciding among hundreds of possible choices may lead us to do some things that seem irrational. So again, if we had, and this is common, and marketers know this, there's a lot of things that we do kind of automatically when we make decisions. And clearly, if we're making decisions between 2 things, there's not too much, problem with that. The cost is fairly low in us making the decision between those 2 things. And however, if we have hundreds of things in front of us, the cost for us to analyze those 100 things will be that much greater. It'll be a lot greater for us to analyze 100 things than it would be for a couple things. And that could actually freeze us up. That actually makes it so that we may actually not make a decision at all because of too many choices in some cases. So this could lead to the idea of bounded rationality, which is basically our head saying, hey, there's too many choices here. We need to make a shortcut. We're going to make some shortcut of some way, generally, oftentimes when there's going to be too many decisions for us, because obviously if we broke down and analyzed every decision as analytically as we can in order to maximize our utility, it would be too costly for us to do. Most of the decisions we make, many of the decisions we make somewhat intuitively. So we may do something like this saying, you get what you paid for, is a type of bounded rationality, which is the implication that high price equals high value. We kind of assume that the high price equals higher value. So if we're going to buy something, we might say, there's the high price, there's the low price. Maybe we're going to buy something in the middle. Or of course we might look at the reviews or something like that and make our decision a little bit more quickly in that way, rather than taking in all the facts that are out there. So notice that in the classical theory, we would say that as long as the facts are out there, we should have all the information, take in all the information and make the choice. But of course, in reality, that would take a lot of time and it would cost, and therefore shortcuts happen. Another example is the follow the leader. Leads to focal point equilibrium, in which a set of goods is consumed because they have become focal points to which people have gravitated. So people may choose to make decisions based on what someone else has done. So we might look at a certain individual and follow that individual to see what they're doing. And once again, that's going to help us to make a shortcut within the decision. We see this type of thing in the stock market. Obviously, the stock market changes a lot, and a lot of people would say, well, that's just people's opinion about the market. It might not reflect the realities of the market. And we can see this can get dangerous sometimes when, these type of things do not actually reflect value. We see it in Christmas presents and stuff like that, where something becomes popular and then all of a sudden that's kind of the focal point because everybody's basically following the leader in that way. Tastes are given. This is another assumption that we make in our model. We're going to say that people basically have the tastes that are given to them. People have inherently tastes that they are acting on and acting on their choices given these tastes. So implicit in the theory of rational choice is that utility functions are given, not shaped by society. Given taste is the assumption on which economic analysis is conducted. So we're assuming everybody has their own internal tastes, and that's what they're figuring out their personal utility on. But we know that actually tastes are often significantly influenced by society. So clearly we're not acting in a bubble. We're not making our decisions and having our own internal taste and maximizing our utility just based on our taste. We are influenced by society. So conspicuous consumption is the consumption of goods, not for one's direct pleasure, but as showing off for others. So this is an example of this idea. We all see that often luxury goods, of course, are going to be purchased in large part, not just to maximize possibly our personal utility, but in order to kind of show off. And that's an indication of a time when we are not just looking at our, personal utility or our personal taste. That's an indication that we are enacting or acting in accordance with society, which is influence. That's outside of our typical model that we need to consider when we are applying these models to certain situations. Individuals maximize utility. So people may not behave rationally in practice. So, and again, I don't like the wording of this all the time because I think this examples do indicate people acting rationally. But I think when we think about the utility, classically, we haven't thought about these types of behaviors in the utilities. If we think about these types of behavior, I think they are rational. So it's just that we have to look at our theory and try to account for these types of things, which is not easy. So, for example, behavior economics have found through experiments that many people do not maximize utility. So the experiment of the ultimate game shows that people care about fairness as well as income. And again, this seems rational. This, to me, right? It is rational for us to make decisions based on what we believe is fair, not just based on the income. So we are getting some type of utility based on what we think is fair. The classic example of this is a game in which we basically have a person A and a person B, and we bring them in. We say, hey, we're going to give $100 to person A, and then person A has the option of divvying up the $100 in any way they want between person A and person B. And as long as person B has, the only choice that person B has is either to accept the divvying up of the money or to reject it. If they accept it, then they both leave with the money. If they reject it, then neither of them get the money. So if we were thinking about game theory, if we were thinking about someone going into the experiment and leaving and maximizing their utility in terms of dollars, then we would assume that person B should get any kind of payment that they can get, and we would assume that person A would maximize their utility knowing this by saying, I'm going to accept as much as I can because I know that B has no control over this game and B is well off no matter what happens. So in this, you would think that A would do something like keep a larger portion, such as, keep $90 and give $10, with the assumption that B will consume $10 and be happy with that. And but that's not actually what happens a lot of times. A lot of times A actually says, okay, I'm just going to split it up 50-50. And when we think about that in terms of utility, in terms of dollars, we go, well, that's not rational given the outlet of the game, because you should want to get more of the money. And even when we make the dollar amount significant, this type of thing happens. So we might think that, well, that's not going to happen when it's only $100 and the people that's not relatively a huge amount of money to them. Even if we put the experiment in places where $100 is a lot of money, we find these types of results. And on the other side, on person B, you would think that even if they received a lesser amount, that they would say, okay, that's better than I came in with, so rationally I would accept that, right? That $1 is better than no dollars. But if person A gave a divvy up of that 90-10, it becomes a lot more likely that person B is just going to say, take your $10, and I don't think so, I'm not going to do it. And notice that, once again, that to me, that doesn't mean that the person is acting irrationally per se. It just means that we're not accounting for the utility of fairness. Fairness needs to be in the calculation when we think about those types of things. Just some other applications where this might be useful. There's also been experiments in terms of should we incentivize, say, children for reading financially, or some other incentives, a lot of incentives just to behave well through reading, or some type of incentive that would be financial. And the same kind of ideas are in there. The question is, does the fact of us giving the money actually taint the outcome of the reading? It's something we need to consider, because it may be the fact that the people might start reading for the wrong reasons. They may start reading not for the pleasure of reading, but just to receive money. And when they don't receive the money, is it the fact that they will stop reading, or is it even the fact that they'll say that I won't read for money because I think that feels wrong, feels like a bribe maybe, rather than if you were just to ask me to read, then it might be more likely in some reasons. And I know that may seem counterintuitive, but that may actually be the case. There's another example that was kind of interesting that takes the same idea into place, and that is where they were trying to find a place to put a hazardous dump type area, and they went to a remote place where they wanted to locate the dump. And there were some people that lived in the vicinity there, and they asked them, we need for the region to basically find somewhere, and we've mapped out everywhere in the location, and this is the best place that we can find. If we put it up to vote, would you accept this? And the vote apparently came out to be like 50-50, or actually a bit in favor of accepting the area to be placed there. And they actually came back later and said, we're going to sweeten the deal a little bit and actually give a fairly significant financial incentive on top of that, and say, and you would think from a classical economic standpoint that would sweeten the deal a bit, and the people would say, okay, if it was 50-50 or close to it last time, you would think that a financial incentive would tip the scales, and now it would be good for sure. And they found that it actually did the opposite. It did the opposite of what you'd think. More people said that they don't want the toxic waste there, or the waste facility there. I mean, it's got to go somewhere, and they now say that they would refuse to have it there if it went up to vote. And the question is, of course, why would that happen? And one of the explanations for that would be, well, when you first asked us, we did it out of the good for the country, because we assumed that you looked everywhere, and you came and you asked us out of, we've looked everywhere and this is where it has to be, and out of the good of the country, they were doing something for the country. And on the second one, it might be that they assumed, well, now you're kind of trying to, it feels wrong, you're trying to bribe us to put this thing here, and that's not why we wanted to do it. So notice that these types of things don't always happen. Our original model still works most of the time. If we're talking about selling goods and services, we don't have this problem. If you ask, I'm going to sell you this thing and I'll lower the price, then our model generally works. We don't have this kind of moral issue where the amount of compensation actually deteriorates from us wanting to do it. But when we apply the same type of principles to other types of things, where people are getting intrinsic value in some other way, either through their sense of fairness or their sense of duty or some other kind of thing, and then we pay them, it could actually have the opposite effect of what we would classically think would happen. We obviously have to keep that in mind.